Before we continue, take a moment and comment below on what topics you want us to cover in future videos. We always check your suggestions, and they help us decide what to create next. Now, reversal trading can be a bit tricky because we're placing trades against the dominant trend. But the benefit of reversal setups is that they can offer a very high risk-to-reward ratio. The strategy I'm about to show you is a combination of three key concepts: a major level of structure, a double top or double bottom pattern, and the Fibonacci retracement tool. Now, let me show you what a major level of market structure actually is. A major level of structure is an area where the price has been rejected multiple times, acted as both support and resistance, and was recently respected. These levels are powerful because they often cause strong price reactions. When the price reaches such a level, it creates a great opportunity for a potential reversal trade. The second element is the double top or double bottom pattern. This is a classic M-shaped or W-shaped pattern used by many price action traders. But we use a simple rule to confirm whether the pattern is valid. In the case of a double top, draw a box from the highest candle close to the wick of the first test. For the second test to be valid, its wick must at least touch the box, and the candle body must not close above it. The same concept applies to the double bottom. Now, let me show you how this reversal trading strategy actually works. We use two time frames in this setup. First, we analyze the higher time frame to understand the market structure and find a major level where the price might get rejected. Imagine if this line chart is our higher time frame price movements. We can see that the market was in a downtrend, but after reaching a certain level, it failed to create a new lower low, showing a loss of bearish momentum. Then the price broke through a key supply zone, which means demand has taken control. Now we identify this major level of structure that was previously respected as both support and resistance. Since the market has reacted to this level multiple times in the past, there's a high chance it could reject the price again if tested. So this area would make our optimal trading zone to go long. Also, there's still a lot of space for the price to move up before hitting the next supply zone, which makes this a strong setup. The next step is to wait for the price to reach this structural level. Once that happens, we zoom into a lower time frame to find a precise entry. On the lower time frame, we look for a valid double bottom to confirm the reversal. When the price breaks above the neckline and completes the pattern, we take our Fibonacci retracement tool, measure from the start of the move to the top, and place a buy order right at the 61.8% level. We put our stop loss just below the swing low, and our target will be the next structure level on the higher time frame. Now let's look at a real example on gold. On the 4-hour chart, we can see that the price recently broke above a key supply zone. That means demand is now in control, so we are only looking for buying opportunities. We can also identify a major level of market structure that has recently been respected as support and resistance multiple times. If the market pulls back to this key level, it becomes a perfect spot to look for long trades. Once the price taps into this area, we zoom into the 1-hour chart to look for entries. Now, on the 1-hour chart, we can see much more detail. After hitting this level, it has formed a double bottom, showing a strong rejection. After that, the neckline breaks, which confirms the reversal. But if we enter the trade right away, our stop loss would be too big. So instead, we wait for a pullback to get a better entry price. We apply the Fibonacci retracement tool from the low to the high of the move and place our buy order at the 61.8% retracement level. Our stop goes below the swing low. Once the trade is active, we manage our position carefully. You can close half of the trade once the price reaches twice your risk, making the trade risk-free. Then, you can close the remaining part when the price reaches the higher time frame supply zone. So guys, that's it for this video. I hope it brought you some value. If it did, please smash the like button to support the channel, and I'll see you in the next episode.
Hello traders, I'm Nevan from UpDownFX. This video is part of the Trading Basics series.